welcome to this deep dive where we are, we're looking at something that honestly sounds completely illegal at first glance. Like if a trader has $500 in their account, how exactly do they command a $50,000 position in the market?
Yeah, it really does sound crazy when you phrase it like that.
Right, like without taking out some massive personal loan, how does that happen? So that is our core mission with the research stack you shared today. We are decoding the actual mechanics of Forex leverage and how this extreme scaling, actually works under the hood.
And I mean, the immediate assumption is debt. It really feels like borrowing $49,500 just to execute a single trade. But the reality is entirely different, and it all comes down to how brokers handle this thing called margin.
So it's not a loan. I guess it's more like putting down earnest money in real estate.
Exactly. That is a great way to look at it. So if you want to open a $100,000 EURUSD position, say at 1.1 under zero leverage, the broker isn't lending you 99 grand.
They just need some skin in the game.
Right. They're just requiring you to lock up $1,000 of your own capital as collateral. You don't own the whole house. You're just putting down enough cash to prove you can cover the immediate, price fluctuations of that asset.
Oh, I see. And what's really fascinating here is that the market's volatility doesn't change. A 1% move is still just a 1% move.
Right, exactly. The market doesn't care about your leverage.
But because you've scaled your exposure, it's like using a magnifying glass.
Hmm?
That 1% move is now acting on the full $100,000 contract. Your $1,000 in earnest money is basically holding the door open for the gains or, the losses of the entire position.
Which is exactly where the danger lies. Because those outcomes are calculated on the full exposure, not just your tiny margin deposit.
Right. And here is where it gets really interesting, because I want to push back on this a bit.
Oh, okay. Go for it.
Because you see these brokers offering massive 1.500 leverage, right? If you're putting down such tiny collateral for huge market swings, aren't they inherently setting a trap compared to a safer 1.3U account?
Well, it definitely looks like a trap if you conflate available leverage with used leverage.
Wait, what do you mean by that?
So high available leverage just means lower margin requirements per trade. The broker isn't being reckless. The recklessness actually comes from what the trader decides to do with that newly freed up capital.
Oh, okay. So if I have 5 grand in my account, but I only open a 10 grand position, my effective leverage is really just 2.1.
Precisely. You are actually trading very conservatively there, even if your broker technically allows you to go up to 1.500.
Making sense. I don't have to max it out.
Right. The trap only springs when traders see all that unused margin and decide to go all in. Over-leveraging your available equity is what actually gets you in trouble.
Because if a trade goes against you, those magnified losses eat directly into your free margin.
Yes, and once that free margin drops to zero, the broker forcefully liquidates your positions. It's an automatic stop-out just to prevent your account balance from going negative.
Which explains why, when you look at the interface of a platform like MT4 or MT5, free margin is displayed right at the bottom, constantly updating.
Just staring right at you.
Yeah, exactly. It is your literal buffer against getting wiped out.
And protecting that buffer is how the professionals survive. They don't size their trades based on the maximum margin the platform allows.
So what do they base it on?
They size them based on their stop losses. They figure out exactly what they can afford to lose before entering the market at all. And a huge part of that defense is understanding correlated pairs.
Because you can accidentally leverage yourself to the moon without even realizing it. Like if you go long on EURUSD and GBPUSD and AUDUSD, you might think you've diversified across Europe, the UK, and Australia.
But you haven't. Because the US dollar is the, quote, currency in all three of those pairs, you've essentially just made a massive triple-size bet against the dollar.
Wow. So if the dollar suddenly strengthens,
all three trades tank simultaneously, and your free margin evaporates 3 times as fast. As brokers like Monaxa point out in the research, leverage is just a tool, but survival has to be the absolute foundation of your trading strategy.
So what does this all mean for you listening? It really reframes the whole concept. Leverage expands your opportunity, right? It lets you access markets that normally require heavy institutional capital.
But without disciplined risk control, that exact same access will just pull you under.
Since it equally amplifies the financial impact of your decisions, it forces you to look at your own behavior.
It's a mirror, yeah.
Which leaves us with a lingering question today. If leverage equally amplifies wins and losses, does true trading mastery rely less on having a perfect predictive edge in the market?
That's the real question.
And does it rely almost entirely on the psychological discipline to just, resist pressing that maximum leverage button. Something to chew on.